I've appreciated knowing you for all these years, and we met back in London in 2008, I think.
When I told you not to do markets.
When you told me not to do markets, which was probably good advice, but the 26-year-old in me did not follow that.
No, I think you took the right decision.
It's all right.
The Business of Betting podcast is presented by Optimove, the #1 CRM marketing solution for the iGaming industry. 4 out of the top 5 U.S. operators personalize player experiences with Optimove, the #1 CRM marketing solution for the iGaming industry. Learn more about Optimove by requesting a demo at optimove.com/businessofbetting. And if you like what you see, you will get your first month free.
What is up, everybody? I am Jason Trost, the host of Business of Betting podcast. I am joined today with Nigel Eccles, the founder of FanDuel, who that's how you probably know him. And he's now the founder of a company called Checks Notes, BetHog. Very interested to hear the story of that name. Welcome back to the pod, second-time guest.
Thank you. No, thanks for having me on. It's an honor. Second time.
Yeah, it's like you're kind of becoming the Tom Hanks of the podcast, so maybe we can get up to 5 or 6 times, and we'll see how you do. That's a very impressive fireplace you're sitting in from.
Yeah.
You want to tell us a little bit about your background?
Yeah, this is, in fact, I've got a Christmas tree just to left over there.
Lovely.
Christmas tree. Yeah, so I live in Westchester, so this is a Tudor that we bought a couple of years ago, and this is my library, office.
And is American Tudor the same as British Tudor, or do we bastardize it like a lot of...
It wasn't built under the Tudors, so I think a Brit would call it a mock Tudor. It's funny, when we went to buy a house, the one condition I had was not a Tudor. Any style, colonial, whatever. Of course, we ended up with the Tudor, and it's great. It's an old house, which means that, the air conditioning fell apart, and then so did the heating and all that stuff, all good stuff. But it's just a really nice house, and we decorated it up for Christmas.
We've traded places. I grew up in suburban Connecticut, now you're in suburban New York, and you cut your teeth, and I know you're from Northern Ireland, but you spent a lot of time in London. Now I live in London, so we've traded places.
Indeed. Just like Eddie Murphy.
Yeah, we got to go trade the orange futures now.
Yes.
One of my favorite trading movies, actually.
Yes, it was a great movie.
Speaking of trading places, I thought we could kick off because there's been a lot of talk about the UK economy and the US economy, especially because of the elections that just happened in both these countries. And, I think a good jumping off point was there was an article in the FT recently by Ian Hogarth, who is the ex-founder of Songkick. He wrote an article, Can Europe Build Its First $1 Trillion Startup? And I found a lot of the points interesting. And I've been in the UK more or less for about 15 years, since 2007. And I think you've been in the US probably for 8 years, something like that.
8 years now, yeah.
So we both have kind of spent time in, the opposite country and since I've been in the UK has always been trying to create a new Silicon Valley, try to create this right ecosystem. And, I guess it would be fair to say that recreation hasn't taken place in Europe or the UK. I mean, London still has a thriving startup scene, but it's like a drop in the bucket compared to Silicon Valley. Even, I don't know how you compare New York to London, but I would say probably New York startup scene has a strong edge over the London startup scene.
Significantly ahead, I'd say.
So, one of the big things that Ian was calling out in the article was that we need to celebrate founders more, celebrate the successes. People are selling too early. But my 2 takeaways from the article, and we'll use this as a jumping off point, my 2 takeaways is that there's not enough emphasis on studying computer science. I think in America, computer science is celebrated more. I remember I went to a lecture at the Royal Institution. I think I'm saying that right. And this woman, she's very well-intentioned, but she came up to me and she said, "What did you study?" And I said, "Computer science." And this is, for those of you that don't know, it's a famous lecture hall in London full of historical academia kind of environment. And I said, "Computer science." And she said, very well-intentioned, "Why didn't you study something real?" And I think she meant by real, like literature or like a hard science and I think there's something in the UK that kind of prevents normals, I might call us, normals from wanting to study computer science because, like the sort of the crown jewel in the UK power system is this sort of PPE system. And the second thing I would call maybe the X factor, sort of the American zeitgeist, the American culture that, the YOLO, fuck it, let's go for it. The kind of, that vibe fits really well with startup vibes, and Brits are more like, and have kind of a, let's start there. What do you think about those 2?
I think having, started startups in the UK and the US, I'd say there's problems everywhere in the stack in the UK. Like never set up a company in Europe, but I suspect it's like the UK, but worse. So where are the issues? And it's not like one person or no one person can do anything. So it's not like VCs are just like, they're not ambitious enough. Because when you talk through the different parts in the stack, you realize that no one group of people can fix it. So you have, right at college level, I don't think computer science is emphasized enough. I don't think it's appreciated enough, as you say. It's a little like, in Saudi Arabia, are you going to go into the oil business or are you going to go into the, computer science business, right? You're going into the oil business. And so it's kind of they could call the curse of oil, how oil is like made lots of countries poor. I think it is a perverse incentive in the UK that people are like, oh, don't go into engineering, computer science, because the real money, the real jobs go to people who do PPE and go into banking or go through that route. I think that's a real issue because value creation today is coming through computer science. So like you only have to look at the divergence of the US economy with nearly every other country. It's driven by technology. So I think that's the first area. That means that people who are really good are not going into computer science. I think in terms of entrepreneurialism, I think culturally it's just not nearly as strong. I even saw it at sort of FanDuel when we've looked at post FanDuel. Now, it wasn't a straight A-B split because we had more engineers in the UK and we had more like business functions in the US. But I could list so many more businesses of the people from the US who've gone on to do other things, and only a very small number of people in the UK that have done it. And so that's just sort of natural entrepreneurialism. I think that you then run into the challenge, which is seed investors. So terms, so you raise less money at worse terms in the UK. It's better now than it was 15 years ago, but it's still true, right? No one's raising 100 million at a pre of 500 for an AI startup in the UK. Never, it's just not happening. You're only doing that. And also, you're probably only doing that in the Bay Area, but you're doing it. People are doing it. Then you have problems of the later stage funds, which is they just don't really exist in the UK. You're really having to come to the US. And then lastly, I don't want to go on for too long, but just size of market. Like the US is just a huge, generally homogeneous market, whereas the UK, if say you launch a company in the UK and then you really have to start again on every other country. There's no common market, whether the UK was in the EU or not. They're all very discrete countries. And that just it means that, when you see companies, I think Just Eat was an example, it had to grow by sort of acquisition and bolt-ons as it sort of put all the different countries together. Whereas something like DoorDash just went, boom, we're going out to, all 320 million Americans today. So that's a huge handicap as well, which is size of the sort of the domestic market.
It's been talked about a lot in the FT and other places. Like the UK economy is struggling, whether it's because of Brexit, whether it's because of I believe productivity is going down, or at least it's definitely going down relative to the American economy. Whether that's because of shrinking population. I mean, there's a lot of different causes for why the UK economy is in a tough place. Do you think that the UK economy should be trying to lean into tech to kind of jumpstart it? Or do you think it should lean into more of its traditional strengths, maybe sort of trade or maybe old school manufacturing it used to be quite strong in? It's got some unique exports like cars and whiskey and wool and things like that. Like, where would you restart the UK economy?
Like, the question is, do you want to grow? I think if you want to grow, you have to invest into technology. Now, some of that could lend on traditional UK strengths, which is like finance. Like the UK is actually the one area that the UK is strongest in for startup is fintech. That's something that I would be leaning into. I would be 100% leaning into crypto because crypto is fintech. For a moment there, hot moment, like the UK could have been, like a real center for it. I don't think they did. And I think the US is now absolutely embracing it. So I think that you have to, let's look at growth of the S&P 500. Like, what's driving it? It's, it's NVIDIA, it's Microsoft, it's Apple. Like, these are all companies it's Tesla, I go on. They're all leading heavily into AI and IT. So there's no way, whereas, you look at like the UK stock market and what's the top companies, they're petrochemicals and they're banks, right? Now, I'm not saying that they can't grow faster. I think they can, But is there a $1 trillion company there? I don't think so. I don't know if there's any technology companies. Maybe there's one or two in the FTSE 100. That would be worrying to me because, if I look at that and I don't see any technology companies there, I'm like, okay, over the next 10 years, which of these companies is going to grow 20x, 30x? And there will be companies in the S&P 500 who will grow that easily over the next 5 years.
So I guess I agree with you that the UK should be trying to lean into this, but I can't think of too many quick fixes. I mean, if you buy into that argument that we should study computer science, like that's quite a big lift because the historical the country of Shakespeare and lots of, Chaucer and all these other people, there's this really strong legacy of literature and philosophy and politics and, sort of I don't know, you might call it a strong sense of humanities, and probably also traditional engineering is quite good, math and other mechanical types of engineering. Like, I don't know how you get to shift the country to be more forward thinking. Maybe it's increasing the places at public universities. Maybe it's making sure it's part of the national curriculum.
Like, I wouldn't be pejorative and say it's forward thinking because then you start to get a question of like, what is progressive? What is forward thinking? I think it's like more of a more basic economics question, which is, let's be real. Do you want to be poor, right? Like, do we want the country to suffer 1% to 2% growth at best over the next 10 years? Or do we want to see the country accelerate and show fast growth and be, in 10 years' time, much relatively more successful? Like, do you want to be to look at a country in Europe, which is Poland, which has seen incredible growth over the last 10 years? I don't think any of it's easy. None of this is easy. But what's the alternative? The alternative is to say, we can't do all that stuff. It's too hard, right? Like that to me is insane to make that decision. Even more insane is to identify the issue and then not do anything because it's too hard. Like, it's just like, that to me is like, or sort of believe that it's fine. It's fine. We'll figure it out instead of actually, making hard decisions.
Now, you live in the UK. I think you moved for FanDuel. Is that correct?
I did, yeah.
And that's the reason I moved to London for Smarkets, and that's the reason I'm here. But, I think you're probably in a similar boat to me. Financially, we have the flexibility to more or less live anywhere we want to in the world. My wife's French, your wife's from the UK. And, my wife and I are always debating where should we live. And, I think if it weren't for Smarkets, I probably wouldn't be in London because I'm into tech, I'm into fast-growing companies, and I think that the energy for that is mainly in the United States. Are you staying in the United States because you feel that energy? Or, like, generally speaking, I think the lifestyle of Europe, I would, loosely put the UK in the sort of the Europe bucket, is nicer, and it's a nicer place to raise kids in Europe. But from a work dynamism, going places kind of vibe, I think the United States is much stronger.
Quality of life, I would say is actually very similar in terms of so people often compare, like they'll walk into like Times Square and go, bloody hell, I couldn't live here. And I'm like, you know what? Neither could I. And I don't think most people go to Times Square and they go, I couldn't live here. So I live in a suburb of New York. I used to live in Edinburgh. Actually, I lived more in city in Edinburgh. And so here, I actually got surprisingly, got a bigger house for probably similar amounts of money. But in terms of raising kids, good schools, so I think quality of life is very similar. The real difference is economics. Like, there was one point about 2 or 3 years into being here that we sort of wobbled and we thought maybe we should go back to the UK. Then that was an option. And I was sitting with my wife, and if you remember the Monty Python sketch, which is what did the Romans ever do for us? We were like, well, what did being in New York ever do for us? And my wife was like, well, she's an entrepreneur. And she said, well, I would only got to raise my seed round for what we weren't here. And I'm like, okay, apart from that. And said, and my A round. And I'm like, okay, you're senior A. And I was like, well, I don't think I'd have raised my seed round either, or my A round if I'd been in the UK. And so we were like, well, apart from that, and I don't think I would have been able to hire this person. And you just started to go through the list and are like, okay, there's very real evidence that our life as an entrepreneur was dramatically easier in the US than it was in the UK. And that just was a fact. Like, we considered it and we were like, okay. And so then we kind of stayed, and we haven't certainly not regretted it. I don't think there was, as I look over it, really any quality of life London's very expensive. I'll say that. We used to live in London. It's more kind of equivalent to living in New York. That was the only thing.
Why were you thinking about moving back to the UK? Was it to be close to family and
Yeah, it
teach
was
your
kind of
kids
more
your country?
family. Yeah, we just sort of, this was about 2 or 3 years in. And then since then, we've never thought about it.
And do your kids have American accents?
Oh, 100%. Like my oldest is sort of more mid-Atlantic. My youngest
Okay.
turned American within about 6 weeks. She was just like, boom,
Awesome,
American.
Dad.
Yeah,
Dad.
making fun of my British accent.
I follow this as a hobby. I follow geopolitics as a hobby, and I'm by no means an expert, but I feel like it like bodes very poorly for the world. I mean, the United States is in a great position right now, like Trump's fucking craziness notwithstanding. But our economy is on fire. Like the world's becoming more isolationist. We're in an isolationist phase, and America is just set up so well for that because we have food independence, energy independence, and I'm scared for the rest of the world because the rest of the world has been built largely on trade. And if trade retracts and if entrepreneurship retracts, it's going to be mostly okay slash good for the U.S. and mostly bad slash really bad for the rest of the world. And I'm kind of afraid for the rest of the world.
I agree with that. And I also, like when I'm on Twitter quite a lot, and I see a lot of sort of triumphalism from people in America shitting on Europe. And I sort of have two reactions. First reaction is like, well, what the fuck did you do? Right? Like, you don't take credit for if you didn't do it, right? Like, there's a great comedian. I don't know if you know Doug Stanhope. And
Yes.
you know, Doug, he's got a great line. He says, patriotism basically means we take credit for shit that we didn't do, right? Like, yeah, but you didn't do that, and it makes you hate people you don't know, right? And when I see people on Twitter dunking on Europe, A, it makes me think of Doug Stanhope's line, and B, it just makes me kind of a little sad. Like,
Yeah.
I know there's amazing entrepreneurs in Europe who want to build trillion-dollar companies, and I just think that it makes me sad that they can't do it there because I just don't think they can. And I think there's people who stay there that are there's entrepreneurs in Europe that are every bit as good as entrepreneurs in the US. I've interacted with entrepreneurs in both places. It's not because of the quality of people. It's much more kind of the situation of, the system in the Europe and market effects. I just, there are great entrepreneurs in Europe. There's also bad ones, but the same in the US. I don't think that's the difference. And so I do think it is a little depressing. But I think it goes from sad to whenever you start to think that I don't think the politicians are really going to grasp it. And that definitely makes me sort of depressing.
Yeah. Well, I would say in the United States, a lot of the most famous startup companies are founded by foreigners, immigrants. That just goes to show you that some company, that you don't have to be American to kind of succeed in the system. And, it's more the environment.
Yeah, like you would nearly argue it's better not to be an American because of the success rate of immigrants as entrepreneurs. I think there's great entrepreneurs everywhere. And it's usually the biggest differences are due to like the macroeconomics, the system that they live within. That's the biggest driver.
I feel like I got to say some positive things about the UK because we keep dunking on the UK. Business law is pretty good. Well, you're slightly tapping or stating facts, but it's kind of sad facts because I think you would agree. We want a strong UK. Like we want a strong Europe. We want a strong Europe. We want a strong UK. Like I don't think anybody, even myself as Mr. America, like I don't want to live in the world where the America is the only power. You need different powers and you need different voices around the table. The UK is good at business law, like contract law is very easy to understand. They have concepts about that. It's really easy to hire and fire, which I think is quite nice. Like employment law is quite easy to work with. Raising money on the legal side is very easy to do. Banking is very cheap and easy in the UK. So there's some advantages. And one of the biggest surprises I had is, and maybe this will get eroded over time, but UK software engineers make 50% as much as US engineers. Now, I think that's a big reason why a lot of ambitious people, you were saying like economically speaking, you can make a lot more money. And I think that's why the UK has a lot of brain drain because you can make 2x what you make in the UK and in the US. But as an entrepreneur, it's nice because you can get more ROI.
Yeah. I would say the things I think where I think the UK is really strong on, obviously fintech, finance, London is very, very strong. I think that, this podcast, like betting, the UK is a world leader, without a doubt. If you look at the US market, Flutter is the number one player. The number 3 player is BetMGM, which is half owned by Antiem. And if you went back like sort of 10 years, like that would be a huge surprise, right? Like that the US market, everyone said it was going to be Caesars, it was going to be Wynn, it was going to be Sands, it was going to dominate this market. And the fact that at best, one of the big casino brands is a 50% holder of the number 3 player, right? Like that's quite stunning. So I think the UK is very strong in that category. Doesn't get a lot of, I don't think it gets a lot of love politically, which I think is a real shame. I think there's some incredible engineers, and I actually do think that UK universities churn out a lot of very, very strong engineers. I think there's an entrepreneurial society, and I do think it is valued. Like I certainly felt when I was working in the UK that, you know, like we would be covered in the press. There would be a little bit of cynicism, but I didn't think it was any better or worse in the US. So I think there's a lot of good things, but there's definitely a lot of challenges as well.
Yeah, definitely. Let's pivot to FanDuel. I think FanDuel is an interesting case study for various reasons. Let's kick off with kind of an easy one, but I remember you were, I don't know what the right way to put it, but I think you guys got to unicorn status at one point, right?
Oh, yeah. And when the company finally sold, so the entire company was valued at $11 billion, and our shareholders sold for about $4.2 billion. Our last private round, which valued the company, was in 2015, and that was $1 billion pre.
So maybe this is a silly question to start, but I remember one time you guys raised I was reading it in the paper, you raised like $300 million. And the most I've ever raised was $30 million. And I guess I probably can guess the answer, but like, what the fuck do you do with $300 million? And what's going on in your head when that hits the bank account?
You know, here's a couple of weird things. It actually turns out that raising more money isn't actually harder than raising less money. Like the hardest money we raised was like our Series B, which was like $3 million, something like that, $4 million. Like that was really hard. Whenever you're like a rocket ship growth company, suddenly all these doors open up. The other thing that we discover is at that growth stage, there's a lot of performative due diligence, but it's not like real due diligence. Like at the early stage, they're really going through everything, even when you don't have a lot to show. But at that growth stage, like I think they got Bain to come and do it was Bain or BCG, I think it was Bain, did like a $500,000 due diligence report on it. And I didn't even talk to them until they finished the document. And I remember like reading it and I'm like, this is laughable. Like this stuff, like it basically said what they and, you know, what the investors wanted to hear. So it was like purely a marketing exercise, but it was just like, okay, I guess that's the cost of capital, you know, where if we're raising 300 million, spending $500,000 on a report is like, and it verified it, give that stamp of approval. So I think that's the first thing is raising 300 million is not that different. And in some ways a lot easier than raising like 2 million. The second thing is we had no difficulty spending it because at that stage, we already had, like the previous year, I think we spent 70 million on marketing. By 2015, we already kind of, you know, had a pretty good idea of all the marketing channels that we were going to deploy about 300 million. Today, FanDuel spends well over $1 billion just on marketing. So it wasn't a case of like, hey, what do we do all this money? It was a case of we'd started in 2009. From 2009 to 2015, we had every year scaled our marketing budget by 3 to 5x. And so by 2015, we were like, okay, this is what we did last year. I think we could spend, like, I think maybe we spent 100 million on TV. Maybe it was more 150. You know, we could, okay, that's a TV budget. Here's radio, here's digital, here's all the different channels.
Like I said, like I've raised 30 million and I sort of fell into the trap where before we raised 30 million, I'd raised $5 million over like 12 years. And through that, I had to like, I knew what everything cost. Like I knew what the pens cost. I knew what the chairs cost. I knew what the desk cost. And, you know, when we raised 30 million, I kind of thought my job as an entrepreneur is like, go, go, go. I said yes to everything. I stopped paying attention to what anything costs because I'm like, who cares? We got 30 million. And I ended up wasting a lot of it because once you say yes to everything and there's no cost discipline, things sort of fall apart. And did that happen to you? Did you lose cost discipline with all that money sloshing about?
I don't think so. Like, it's hard to be both, right? Like, it's hard to be, let's go for it at the same time as being like, how much did that pen cost? Like, that is really, really hard. when you're going for it, you do have to make a lot more bets, right? You have to be like, okay, here's a deal. It's $1 million. Do you want to do it or not? Like we sponsored Floyd Mayweather's shorts when he fought the Pacquiao fight. That was $1 million. Or did we get ROI on that? We get a ton of media coverage. Like I still sometimes see our brand from that fight. That one I actually think get paid off, right? I have no way of knowing it, but just the amount of media coverage we got. Whereas other deals that we did that, you spent the money and then like you never saw anything. But, was that wasted? I think once you're starting to get to that scale and you're growing that quickly, it's impossible to just pick the deals that are going to perform. I think the question is, did we overexpand? It's hard to say. The market shifted very dramatically to 2016, where we went from hyper growth to like low growth. And so we did cut back afterwards, but I don't think that we really lost. One of the things that I'm really proud of FanDuel then, and still I think it's true today, is that they have huge cost discipline. When you saw in a sports betting open in 2018 through to today, you don't see FanDuel doing that. Here's the ESPN deal and here's the NFL deal. Like they were more like, who's the kicker for the Colts? Pat McAfee. Here's the Pat McAfee show. Okay, that's cool. They weren't the kind of marquee, most expensive house on the block type deals. And that was a culture that we try to grow from the start, which is we're going to be, mantra was always aggressive but disciplined.
It's funny you're mentioning the Floyd Short thing, because I still remember you doing that. I remember seeing that on the fight, and it's quite a moment, in time, because you had such momentum and it's a high profile fight. How did that happen? Like, did you just give like a $10 million budget to your marketing lead and you say like, do the best you can? Like, did that hit your desk or what happened?
Yeah, that one hit my desk, and it was kind of a funny story behind that one. So that actually came through our affiliate channel. And because we've been working, like this is 2014, 2015, people didn't really work with influencers back then. And certainly like names, they just didn't, it wasn't the channel it is today. And so we worked with all sorts of people like Michael Vick, and we worked with Floyd Mayweather. And then this fight was coming up and they were like, look, do you want the shorts? It's going to be $1 million. And I was like, sure, like this is going to be the fight of the century kind of thing. And we at the same time were raising the 300 million, and one of the investors was Google. And obviously Floyd Mayweather is hugely controversial, for good reasons. And so when Google saw it, they almost freaked out and they were going to put in 50 million. And I'm like, oh my God, is this sponsorship going to cost us $50 million? And so I had to like talk him down from the ledge and say, look, we did sponsor him. It was kind of a one-off. That's not really where we tend to spend most of our money. We kind of came through the affiliate channel, but it came through that channel. But yeah, the way it sort of works is, the marketing team previous year spent 70 million, and, under the CMO, you had different people. This person runs TV, this person runs marketing. And then we work from a bottom up. What is the budget? Like, okay, affiliates, you're going to have, like, you spent 5 million last year. Could you do 20 this year? The same CAC, if it's absolutely critical. And they're like, okay, I think I can do it or I can't do it. So everyone's accountable all the way down. What we never had in our company was someone going, I just think this is cool. Like, we should be doing this because it's cool. Everyone was like, there was no brand campaign. It was all like, I want to know what the CAC for this acquisition channel is. Because if you can't tell me that here, I'm going to spend it over there because they can tell me. And so every time we did it, all the way, we were spending 300 million. We worked out our CAC at the end of the year, but we also knew our CAC by channel. And oftentimes we knew our CAC by show, time of day, date. We knew it all the way along so that we could then go, okay, how do we spend more next year? That stuff didn't work. This stuff works. Let's do more here. So that's how you get to like 300 million. That's how you get to $1 billion.
I mean, how would you handle brand spend under that? Because obviously you don't have attribution and another CAC. And like, how do you know you shouldn't have spent 800 on the shorts instead of 1?
800. Once you get to real scale, trying to figure out a CAC, particularly for like above the line, like TV spend, gets really hard. But it's a lot more doable than some people think. Like, when in 2015, we had something like 5,000 promo codes. Okay, we're just like flying around, all these. I remember there was one called Bear Claw 7. And so we used that to track. We could see time-based, when the ad run, we could see then the registrations popping up. We could then triangulate between those two to say, okay, that we have tracked this many, but we can see that we're getting these other ones. So we're going to add those back. And so what you do is you have your track numbers, and then you end up with this big bucket, which is like 50, 60%, which is on track. And then you do the add backs. And the only rule of the add backs is you can't end up with more than 100%. Like that's the golden rule. Like you're kind of like, because you have the TV guys saying, we should get a 2x multiple, and you get radio saying we should get a 50% multiple. And everybody gets their multiples because everybody wants to have more users allocated to their budget. And then you end up with 150% of the number of first-time depositors, right? You're like, okay, that can't be right. Like you can't be, if we acquired 100,000 and when we add up from the bottom up with your add backs, we're getting 150, there's something not quite right. And so you have to do a little bit of internal negotiation. But then
so you can kind of do some soft attribution.
You can do
that
some
kind of gets
soft attribution to get to your number. And you know your overall CAC because you know how much you spent, you know how many users you got.
Right.
Brand
Got it.
is something I think for any type of growth business, you have to be measuring back to our CAC. I also think that brand marketing, it has to perform on an acquisition basis. To me, the former CMO of, he was Yum Brand, but he was KFC, he was Taco Bell. There's a big company, like big marketing budgets. I mean, what you would say is like a lot of what you would say brand spend. He was like sales overnight, brand over time. What he meant was if this ad does not get tacos flying out the door and is not selling buckets of fried chicken, I don't want it. And all of the best advertising generally I see is that like it will sell. And if it doesn't sell, it's not helping your brand. Or even if you go back further, like one of the strongest, most iconic sports brands today is Nike, right? And kind of like, Nike is the epitome. And a brand marketers love Nike and they'll talk about Nike and you go, okay, go back and read Phil Knight's book, Shoe Dog. And you should read it anyway. Brilliant book. One of the best entrepreneurial books out there. And count the number of times he talks about brand or even advertising. It's like zero. Like he paid a designer $8 to do the swoosh. Like the name they just sort of came up with and they were like, sounds okay. Like, I'm not saying you should be that dismissive of it, but the first 20 years of that company, they never talk about advertising. They never talk about brand. All they talk about is product and sales. And so if the biggest, the most successful brand ever for the first 20 years never talks about brand, like what does that tell you, right? And that's when I have like early, and by early I mean the founders or like in the first sort of 5 years talking about brand, I'm like, you've got it all wrong. You should care about product and sales. Brand comes over time.
So when you were part of this rocket ship and you had hundreds of millions of dollars in the bank, like what did you do to stay sane? Like on my journey, I don't know how many downs you had, but Smarkets has been up, down, up, down, up, down. And the downtimes, like I would drink too much and I would sort of withdraw and I would eat like shit. I had some very unhealthy habits. A lot of it was around drinking, and I would drink by myself, for example, trying to cope with all the stress of being a young startup founder. What are some of the good and bad habits that you did to make it through this period?
Yeah, like I would say, I think one of the mistakes a lot of entrepreneurs make is they sort of see someone else being like super successful and they're like, oh my God, it must be amazing to be over there. And it doesn't help often by DCs. They're like, oh, this guy, they're killing it. And it's funny, you'll go and talk to them and, if you get them to be honest, they'll be like, yeah, it's really hard. Things are not working. And so I think that's the first thing is, I think as an entrepreneur, nearly all the time, I would say 90% of the time, things are not working, or they're certainly not working as well as you had hoped. There's very rare, in the FanDuel journey, I don't remember very many moments where we were like, yeah, we're crushing it. I remember a couple, but this is over, we started in 2007, I left in 2017. So over 10 years, I remember a handful of times we were like, yeah, we're really crushing it. And every other time it was either like, we are totally screwed. Like we have existential, we're going to run out of money next month and no one's going to give us anything, or we're going to get shut down, or the New York AG is going to turn up and arrest me. Like, all these bad things. Like, how did I cope with it? I'm not sure I've got like really great advice there. Like,
did you have a mentor?
No.
I'm in YPO, for example. Like YPO has been a big thing for me. I got a CEO coach like 4 years ago. I was I was pretty good about talking to other founders.
Yeah. So I tried a mentor or like a coach. I didn't really gel for me. It just felt like an hour of me just kind of unloading and them doing, like, and then at the end of the hour, I'd be like, okay, I'd give up on that one. It didn't work for me mentally. I find that spending time with other entrepreneurs super helpful. And I advise every entrepreneur, I'm like, don't talk about networking with VCs. They're not helpful. You want to be networking with other entrepreneurs. That's where you're going to get the most value. I think that was a big one. I don't know, trying to have outside interests is like a good thing.
Did you?
Yeah, I definitely do. Like having a family life definitely helps. I try to work out fairly regularly. I read a lot, but I don't know any successful entrepreneur who's not like obsessed with their business. They can be very boring company, right? They're like maniacally focused. So I think it's important too. I think everyone kind of struggles with that, like balance. I guess one thing is like, as an entrepreneur, I don't expect to have, in crunch times, I don't expect to have great work-life balance, right? Outside of crunch times, I actually think I do have pretty good work-life balance, but there's going to be periods, and those might be months and sometimes years, where it's just going to be like, look, your life's going to be, from the moment you wake up to the moment you go to sleep, you're just going to be flat out. It's not great, but I kind of accept that.
And your wife was a co-founder of FanDuel, if I'm...
So she ran our marketing function.
So was that a good thing or bad thing for your relationship?
It worked. It was good for us. I always advise other people who've asked me about it. I'm like, mileage may vary. Some people are not, like, some people start businesses.
Check your warranty.
Yeah, like it's like some people start their businesses with their brothers and that works really well. I love my brothers, but I could never start a business with them. Like we can barely organize like a road trip together. But my wife and I, for some reason, really clicked. She's easily one of the best marketeers I've ever worked with. So that's good as well. I didn't know that before I started working with her. And, here's the funny thing, like she ran all of our acquisition marketing for FanDuel. When we started, she literally didn't know what NFL stood for. She'd never watched a game. She wasn't a player, but she was incredibly good at understanding what their motivations were and how to attract them and how to like craft the marketing function. So it worked really well for us. I think it was very good for us in that if I were an entrepreneur, she wasn't, I think she'd have really struggled to like kind of understand the pressure that I was under, why I was acting so weirdly. But at the same time, like it's tough. Like you're both always on. Like you would, when you have young kids, you would be like, okay, you work all day, come home, you see your kids, you have dinner, but you're still thinking about work. You get your kids to bed and then you're back to working again. You're just working through the night. And so that kind of sucks.
The other super interesting, I think, about your story is the way it ended, which is kind of a shitty ending. But I think, like, from the outside, you were saying, like, most of the time, 90% of the time, you felt like you were underperforming, which I totally can sympathize with. But from the outside, it looked like you were flying high. You almost did a merger with DraftKings. You were a unicorn before that was kind of commonplace. You raised hundreds of millions of dollars. You were, like, on every bus and TV for a long time. Like, the poster boy of like success. And then my outside version of the history is you were going to merge with DraftKings. DOJ killed that. The business had not yet pivoted to sports betting because it was not legal. And you guys are bleeding cash and the people, the investors were kind of becoming less enthusiastic about continuing to fund this loss-making crazy advertising business. And you ended up selling to Flutter. And there was some kind of shitty deal that the investors did, which basically they sold the company. Okay.
Yeah, let me talk through
your version.
So I think like it's definitely not an ending, and I actually don't think the outcome. So there's probably like three things you sort of think about outcomes. Number one, have you built like an enduring, successful business? And for that, FanDuel is like a knockout success. Like it's incredible to see the success of that business, and like every day that I see it, I'm like, we built that. That's incredible, and the team that built that. I think everyone's really proud of it. And I actually think that a lot of the culture that we created is still true to today. I still know a lot of the team there. And they would say that. They would say, yeah, we have a real cost discipline, but we want to win, right? Like we're not like one of these, like we're a small player, but we're profitable. They're like, we want to be number one. We're going to be number one, but we're going to be disciplined about it. And I think that's great. That was the culture that we set in from day one. So on the first part of the ledger, that's a big tick. Second one, if you raise external capital, you want to give your investors a great return. And we did. So our investors all got at least a 10x return. They would have had more if they had not sold in 2022. But 10x is pretty good. Like we're I know a lot of our VCs, and they're like, we're like one of the stars of their portfolio because they also put a lot of money to work. And it wasn't, for some of them, they invested in 2015 and they got their money out by 2022, 7 years. It's pretty good, right? So get a 10x in 20 years or 7 years is good. The third one is where there's major issues, right? And that's that the people that built the company, the founders and early employees, were defrauded by the board. Like, let's just put it really clear what happened. So what happened here was whenever...
I think before you go into this, it's important to say you guys ended up with zero.
Yeah, so we as the common shareholders,
Got wiped
founder
out.
employees, all got wiped out.
Why don't you talk about the math before you talk about the mechanics? Because I think even though it's clear to us because we've done term sheets or whatever, I think that what a preferred liquidation preference is sort of Greek to a lot of people. Why don't you talk about the mechanics of that?
So FanDuel by sort of 2018 has raised sort of $450 million. And so we have, typically what happens when you raise money is investors get preferred stock and founders' employees have common stock. Preferred is pretty much the same as common with one major exception. Actually, a bunch of major exceptions, but the big economic one is they get their money out first and then they sort of share in the upside. We were called participating preferred, which isn't as common now, but participating preferred is you get your money out first, then you get the percentage of the upside. Normally, it's just a non-participating, which is the better off, which is better for funders. But we were participating preferred. So by 2018, we've raised $450 million. We actually had $559 million of pref stack. So investors get the first $559 million, and then we share in the upside. And founders and employees at this point owned about 10% of that upside, of the common. So that's where we were in 2018. So if we were to sell for $559 million or less, the investors just get their money back and common get nothing. So by 2018, our board is controlled by private equity investors. So there's no founders on the board. There's not even really any representatives of, well, there's one representative of the early stage investors who are aligned with founders. They actually have more common than they do have preferred stock. So you have this board is controlled by these late stage investors. They wanted a merger where they could get the upside of sports betting, but they didn't have to put in more capital and they didn't have to continue to invest in the company. And what they found was to do that with Flutter. Flutter at the time was known as Betfair, Paddy Power Betfair. And Paddy Power Betfair had an asset in the US called, it was Betfair US, which was their TVG racing business. And so this is early 2018. What they engineered said, let's do a merger. We're going to merge Betfair US with FanDuel, and Flutter are going to put in another $160 million. Great. And what we're going to do is we're going to give the FanDuel shareholders 40% of this new company. And that new company is going to be called FanDuel Group Inc., right? So, and it was clear that FanDuel is the go forward brand. Actually, the deal made a lot of sense, right? And I was very supportive of the deal even before it actually went through, because what it did was it really brought the expertise of Flutter and injected it into FanDuel. FanDuel had brand, user base, team on the ground, ready to go. Now, as they were putting together this deal, PASPA got repealed. And so suddenly, FanDuel is in this incredible position, to dominate this market, as it has done, right? And Flutter, the merger actually helps it because it brings in all the sports betting expertise. But here's the thing. If you do a transaction like that, where you're exchanging paper for paper, so we're saying, okay, I'm giving up my 100% ownership of FanDuel for 40% of FanDuel Group Inc., which is this new company, what's the value of that 40%? Now, what happened was, and what would normally happen in this situation is you would have like an arm's length negotiation between a buyer and a seller, or you would have a banker who would go in and say, okay, how do we value 40% of FanDuel Group, particularly whenever PASPA has just been repealed? And if you think about when PASPA got repealed, suddenly like the score, which was publicly listed, goes up 5x. Flutter sees like several billion added to its market cap, even though it has hardly any presence in the US. NTN shoots up. So everything, all these valuations goes up. Instead of doing any independent valuation, what our board realized was that it was in their interest to keep the valuation at 559 million because that would wipe out the common shareholders. They'll say, we're not going to bother trying to find out what the true valuation is today. We're just going to say it's 559 million. We're going to force it through because we control the board, and we're going to wipe out the founders and the employees who are literally in the building when this is being done. And that's exactly what they did. So they basically did that. Now, they had a couple of problems, one of which was that some of the board members actually were aligned with the common shareholders. So they had more common than they had preference. That included the CEO and included 2 independents. So what they did was they basically said, as they call it, an incentive package to align their interests with the preference shareholders. Or you could call that a bribe. And that's what they did. So they aligned them. They pushed it through with the board. There was only one person who dissented, who was one of the early stage investors, but they had the majority. They pushed it through. They wiped out the common shareholders.
Crazy story, and thank you for sharing that. What I don't understand is why you were supportive of the deal. Like, forget past what doesn't happen. You were supportive of the deal. What was going to happen to the common shareholders in that scenario?
I was
did the 10% roll?
So I was
or you got
supportive
wiped out?
No, I was supportive of the deal, the merger with Flutter, and I was publicly supportive but at that point, we had no knowledge that they were going to defraud us in the deal. So,
Oh, you didn't know what the valuation was.
We didn't know
that.
What the valuation was, or what they could have done, which was just been as easy, is to say,
Convert everybody to common.
We don't need to value the company. We can actually, because no one's getting paid out. They could have just said, we're just going to preserve the current structure. And when we ultimately sell, we'll then pay everybody based on the structure. So, and just to finish the story, 2 years after this deal, when they said the value of 40% of FanDuel Group was 559 million, 2 years later, they sold that to Flutter for 4.2 billion. It sort of magically went up by 8x in the period of 2 years.
And it should be noted that you're in litigation with them right now.
Yes. So we started suit even before the deal closed. Even before the deal closed, we actually filed suit saying, look, this is clearly fraudulent, obviously and, transparently fraudulent. So we filed suit. We then refiled in New York because that's where I live and where most of the shareholders live, and it clearly has jurisdiction. And so we refiled in 2020, and then we're still in court, and we're working our way through the labyrinth.
The super fast New York courts.
It's amazing. We went to, one of the things that they filed was, so they filed a motion to dismiss, and one of their claims was that they didn't owe a fiduciary duty to shareholders. So not that, this is not a claim that they shouldn't have done what they did. What they're saying is, we don't owe you any fiduciary duty. Our duty is not to you. We don't have to act in your interest. That went all the way to the Court of Appeals in New York, who found in our favor. He said, no, you do own a fiduciary duty. You do have to act in the interest of shareholders. And so that's where we are at the moment. And now we're proceeding with the court.
Let's say your version of the event is correct. You said that employees and the founders own 10% in total. What's your hypothesis why they did this? Because they just saved 10% of shareholders? It doesn't sound like that's a good enough uplift to go through the risk of defrauding.
Have you ever met private equity?
Was that the only
a dollar's worth more than 90 cents?
So is that the perk? That's the only perk, that they just save 10% of the. They have
this is this is hundreds of millions of dollars.
Yeah.
Doesn't
feel like it's worth the risk to fuck everybody over for 10%.
It's welcome to private equity.
All right.
Honestly, no. I don't think that's true. I think this is fairly exceptional circumstances. I think it's fairly exceptional, even within private equity, to do this. But they did it. So I don't spend a lot of time sort of thinking about why they did it. They did it, and they seem to be very, very content to have done it. And they don't seem to be contrite about having done it. In fact, they're, in their legal arguments, they're saying the opposite. So I don't really sort of need to spend any time, or I don't spend a lot of time thinking about why they did it. I think it's pretty clear they'd made more money this way.
So my understanding of when you IPO a company is that preferreds all get converted to common, and
That's
then once
correct.
the stock is listed, everything's common.
Yeah.
Like, why in this transaction wasn't everything converted to common? I'm not familiar that how M&A preserves the prep stack.
So if you do like a transaction like this, you could do it two ways, right? One, sometimes when you have like a merger like this, you preserve the existing structure, and you could have looked at it and said, like, we only had restructured the company a year before. And you could have said, in 2017, we restructured the company to have this sort of preferred and ordinary structure. We simplified the cap table. We're going to do this merger. And whenever ultimately the FanDuel shareholders get paid out, we're going to run the waterfall then. So you could have done that. Absolutely could have done that. But that would have been worse for the preferred shareholders. The other thing that you could have done is you could have said, okay, no, we want a valuation. We're going to have to collapse to one shareholder like you're describing, but you need a valuation. You can't do it without a valuation, because the number of shares you're going to get as an ordinary shareholder are going to be very different if you collapse it at 559, which is zero, or 4.2 billion, or whatever number you're going to collapse it at.
Yeah, I guess I'm suggesting that once you sort of do the conversion, the preferreds go away. Everybody
That's right.
becomes
You
common.
would. So when you go public, that's what happens. So you do collapse it, but you have a valuation, and the market sets that valuation. Here, what happened is, well, they had a valuation, but they made it up, right? Like it was like, it was the number, amazingly, because if you think about it, the valuation should be based on some sort of external factors of the value of the company. The idea that they went through a process to find a number that magically happened to be exactly the same as the pref stack. 559 million was the pref stack. It was also the valuation that they magically independently came up with. Seems a little bit unlikely, shall we say.
Yeah. From the outside, it makes no sense. Like, make it 565 or something so you guys get something. I don't know. But to me, the remarkable part of the story is you founded this great, successful American tech company. You rode this giant wave. You were super successful. You got kind of beat up at the end. And then you ended up with zero as the founder of this great American, which is still a great American company. And it's such a, I think, an interesting cautionary tale of how investors don't have your best interests and how pref stack map can screw you over.
On that one, I don't think this is normal investor behavior by any means. Like, I've worked with hundreds of investors over the years, and this is abnormal, highly abnormal. And I have seen investor bad behavior, like, through my career, but this one is like way off the reservation. So like, I went out of FanDuel and immediately went and raised venture money for my next company. I never want people or entrepreneurs to sort of like take this as a lesson, is not to raise venture capital. I think that's the wrong lesson. This was exceptional.
I think it's be careful about your pref stack and don't get buried
Well,
underneath
actually,
the pref
no,
stack.
it is actually, I think it's a very good Warren Buffett phrase where he says, you can never do good deals with bad people. You can't get lawyers to draw around. Investors typically have so many different powers and levers that if they're not acting in your interests and if they don't care about their reputation, they will find ways to screw you, no matter how good your lawyers are, no matter how good your term sheet is. So I always advise people, I'm like, the single most important thing when you're dealing with investors is their reputation and their ethics. That's actually way more than terms, valuation, anything. Because if they don't have that, nothing else really matters. Your life's going to be miserable.
Cool. Thanks for sharing that story. I think it's super interesting from the good and the bad.
From afar.
From what's possible. It's a cautionary tale. You mentioned you started you raising venture. Last time you were on the pod, we were talking about BetDex. Now you have founded a company called BetHog. How many companies have you spun up since leaving FanDuel, and what's your your entrepreneurial thesis?
Yeah, how many have we done? 1, 2, 3, 4. This is 5. This is 5.
That's prolific.
Yeah,
that's very prolific.
So we did a few projects in social. I did one vault in the music space, and then I started a card trading business called StarStock, and then BetDex, that was 3 years ago, and then BetHog this year.
So is there an underlying theme, or is it the idea moves you and you
stuff I'm interested in? Well, I think a little bit of a theme. I've done this before, is every time I leave like a betting company, I'm like, I'm done with the betting industry. I want to do something else. And then
Just
within
when
a
you
couple,
thought you were out.
yeah, and then within a couple of years, I'm like, you know what? I kind of miss it, and it's an industry I know well, and I get back into it. So that's a theme. Everything that I kind of work on it's usually centered around speculation and sort of entertainment. Those are kind of the two things. Like I really like all the products I work on. I'm very interested in the social side of it, but it's also almost always got some speculative sort of gambling aspect is nearly always at its core.
And what are you trying to do with BetHog? Why don't you give the elevator pitch for it?
Yeah, the elevator. So BetHog, a couple of things that we should have seen. And so BetHog's mostly a crypto casino. We have a sports book, but that's not front and center. The focus is the casino side. I think there's two areas that we're really interested in with BetHog. I think number one is we've seen emergence of streaming as like a major acquisition channel for crypto casinos, but the games themselves have stayed the same, which we think is kind of incredible. Like, you've got a streamer who's playing the same slots title, with the 5 reels that I could have played 20 years ago, right? And so that to us is kind of like weird. We were like, shouldn't the games have evolved to actually work better for this audience? And so we're doing a lot working with streamers to build new titles. And so one we've got at the moment called Hogger.
Good name.
It's good. We're basically, the streamer is playing, but the audience can play with them. The audience can bet on the streamer. And so it's very, very interactive. So if you ever had the experience in London, you go into like the casino in Leicester Square and you play blackjack, and because there's a lot of Chinese near there, they will bet on you. They'll bet on your hand if you're playing well. And then if you screw up, they'll be like tutting. They'll be like, you hit the 16 and you hit a 10. They're like, oh, go on, idiot. And they're like, and then, so we actually recreated that experience with Hogger. We think that's kind of like so there's a lot that we want to explore there. We also are really interested in exploring more sort of PvP games. So games where you actually can win because you're better than the opponents. We did that with DFS. We actually think there's an opportunity to do that in like casino games.
Great. And then what's after this? Are you going to keep spinning up companies?
No,
or are you gonna...
hopefully, like the hope is that this one's the big one. And, this one sucks up so much of my time that I don't get sort of bored and say, hey, why don't I try something else? That's the hope.
Well, as always, it's a pleasure talking to you. It's like such a crazy story, and you're a fun entrepreneur too. And you've always been helpful to me throughout the years, giving me advice. And so I've appreciated knowing you for all these years. And we met back in London in 2008, I think.
When I told you not to do SmartGets.
When you told me not to do SmartGets, which was probably good advice, but the 26-year-old in me did not follow that.
No,
so
I think you took the right decision.
It's all right. Well, as always, I'm sure I asked you this before, but what do you want to be when you grow up now? What's your ambition now?
So I turned 50 this Sunday. So I think I'm growing up.
Big boy.
Yeah, I know. What I want to do for the next 10 years, should we say? Like, I don't know. Like, I want to have fun. Like, so what do I like doing? I've sort of thought about this a lot. Like, I love working with product development teams building cool consumer products. Like, there's nothing better than like, getting a call and going, we could build X. So why don't we do this? Release that product, elevate it. There's nothing more fun than talking to consumers who've loved something you've built. Like the number of times I've ran into people who are like, oh my God, I love FanDuel. I played it so much, or like just like crazy stories about playing with FanDuel. So that's what I love doing. I think I'm just going to keep doing it. I do think that I want to make online sports betting a lot more social. I just think that it always strikes me that when I bet offline, and like I'm going to Vegas, I go to the race course, they're always very social experiences. I just find online is a little bit antisocial. Like I always think that a lot of sports betting apps, they've been inspired by banking apps. I just want to get in, get my bet, get out, right? And I'm like, it feels to me that we're missing something here. The online experience should be a lot more social. I think that's what's up in the streaming is a really good innovation. I just think there's a lot more we can do. I think we can do more on the sports betting side and make it more social. It's not obvious. Like lots of people tried the obvious stuff. It didn't work. But I do think there's a lot more we can do there.
Yeah, I completely agree. All right, Nigel. Well, thanks for stopping by.
No
we got to
problem.
get you to number 6. So we're on our way to the Tom Hanks, the Jacket Club or whatever it's called in Saturday Night Live. So thanks very much for stopping by.
Thank you.
And wish you the best with BetHog.
Thank you.
Cheers.
The Business of Betting podcast is presented by Optimove, the #1 CRM marketing solution for the iGaming industry. 4 out of the top 5 U.S. operators personalize player experiences with Optimove, the #1 CRM marketing solution for the iGaming industry. Learn more about Optimove by requesting a demo at optimove.com/businessofbetting. And if you like what you see, you will get your first month free.